many times I have this is the agenda that we will gonna talk about. And first, investment for accommodation for the inherited plans. So we'll in the portfolio, it is imperative to deeply understand the client's inherited circumstances. So their specific investment goals and the balance typically inherited immediately liquidity and growth potential. So each factor plays a pivotal role in shaping a tailored, tailored investment strategy that aims for sustainable finance health. So investment goal of the client should be like according to Chaudhary, like define the client's specific investment strategies. So whether they aim to wealth evasion, income generation, or capital growth. So now we have some of the recommendations for the investors. So the next one is investment options overview. Uh, Investing encompasses various like stocks, ETFs, mutual funds, ETF. Stock represent ownership in companies and carry different risk. There are potential engines for the growth, but require careful analysis of market conditions and company performance through by investments. This can affect rules. The other ones is bond. Bonds are the debit instruments of fixed income with kinds like corporate and government bonds returns. The next one is state according to the Andorra 2024 investing in the properties can provide both income to renters and efficiency over time. The real estate provides income and appreciation, but requires market analysis also. The next one is the individual funds. Individual funds hold investment for diversification. Those investment vehicles allow investors to diversify across a range of assets without requiring the extensive knowledge of individual stocks. Next one is the ETF. ETF offers similar benefits with real-time trading flexibility. Understanding each for effective instrument strategy and effective investment strategy imposes a diverse range of options such as some with distance attribute that could affect risk, appetites and return capacity. Is understand the stocks, bond, real estate, bonds, and ETF provides a solid foundation of an investment profile. The next slide will be now we'll talk about the risk return of individual stocks. Okay, for stocks, so there are past, future, like we have invested somewhere, we need to invest somewhere, how's the taxes going, how much we will get, and so basically the expected return, there is really, we see the historic data of the company, like how much earning, how much the shareholders have the stakes on it. So according to that, we make the decision which stock is good for it and how much risk is there and how much is to be invested in. So voluntary measure and associated messaging voluntary indicates the degree of variation in stocks pricing over time. So informing risk tolerance and investment strategy, there are high volatility can imply higher risk but also present opportunity for significant returns. So the tax implication, understanding the tax and the consequences of investments. So the stocks, the tax implications on the stocks are how much are you withdrawing from the portfolio account because if you are not withdrawing, there are no tax. But if you are making money like over 250, so you need to pay a tax. Or if you are withdrawing more than some amount of money, so you need to pay tax according to which time are you doing. So in the future you are doing right now you are doing so there are different percentage of the tax nowadays. If you are earning like more than 200 300 case you need to pay 30%, and if you're earning uh 40 400 500 k 600 k you need to pay 40 50% of your wealth to the government. So there are maximum returns you can do on the stocks. So now we will do what's my friend is will detail on it. There are many types of bonds, different bonds categories, such as corporate, remittance, various bond needs, which has usually risk and return characteristics. Bonds come in various types. Uh, the next one is the interest rate risk. The interest rate is increases in interest rates can affect bond prices inversely, where all auto adjustment of the risk is vital for bond investing and decision. The other one is the credit risk, evaluating the credit worthiness of bond issues and determine the likelihood of default to the borrower who could for understand credit rating and their uses is essential in the selection on including our investment profile. The next one is the tax implications of the act. The reflecting tax implications of bonds investment can differ significantly based on the bond type. The defensive assessment of bond requiring understanding the diverse type of available inherited interest rate and credit risk as well as the tax implication associated with the bond investing crucial role in the keeping a well-rounded investment strategy. The next slide will explain my so how much risk and return we can get on real estate. So, so investment essentially through comparison of market dynamic, rental income potential, capital appreciation, and the tax implication derived from property ownership. So this significantly influence investor outcome in the real property landscape. So the rental income potential, like evaluating aids in establishing the viability of property investment of generation income streams. The capital depreciation of it, like if you buy the property in some area and after some years in future, but it is a developing state. So if after 5 10 years you are going in urban area, rural area. So it depends on the property how much you buy and after 5 10 years how much you are getting and you can get the benefit. You can get tax benefit on it and as a real estate return you can get more return in upcoming future because right now if you invest 100k on it, so if you get you need to wait for 5 10 years to recover it and then you can get your money more return on it. And the market then analyzes the market then provides insights the demand, supply and the valuation in the real estate sector. So as a Lauren said it of the demand supply valuation as the concept of macroeconomic indicators can improve better investment decision in property asset. So we can see uh, if you're like where we're investing, so we can see the thing like how's the economy over there, how's the money flow over there, how's the investor are there. how much investors are investing in that area. So according to that, we decide, we tell you to buy it and how much time you need to hold it, how's the mortgage, and you can also get the mortgage benefit. Like very type of benefit, like various kind of benefit on that there's application in the listing market. So now the next slide, mutual fund and ETFs will explain why I find it. Good. That is complete return analysis based upon the ETF. Mutual funds and ETF provides to analyze performance metrics like returns, short sale, also alpha to the access effectiveness. The next one is the management. This management is basically what pushes higher yields can diminish significantly higher return. Evaluating this picture is important. Additionally, the next one is the technical implications, uh, the technical implications, constitution, um, understanding the tax implication, including the calculus, distribution, essential for optimizing of that and our investing strategy when evaluating mutual funds and ETFs and in-depth understanding of their diversion capabilities, management tools, performance metrics, and tax implications. Knowledge, this knowledge gives an investor the ability to make informed decisions that align with their broader financial goals. The next slide will be explained by my friend. Yeah, so the market hypothesis implications of investment decision. So like we'll talk about market efficiency, investment strategies, behavior, finance, and strategy. So firstly, we'll tell the exploration of the capital market, provide insight into the predictable nature of market movement based on available information. It encourages investors to adopt a strategy balancing between passive and active management approaches while considering behavior factors that may skew market reality. Yeah. So, so the market efficiencies, the premises of market efficiencies are said that all available information is already reflected in the stock markets. So implying the consistent or outperformed based purely on information advantage is unlikely. And recognizing the nation helps investors revisit their expectations. Yeah. So there are like levels of market efficiency, like weak form efficiency, semi-strong efficiency, strong form efficiency. So we can decide like the weak form efficiency is the soft reflected, the historic information. Semi-strong information is like incorporate all publicly available information, and the strong efficiency is like software reflect all information, including both public and private insider information. Yeah. And the investment strategy. The investment strategy is like uh, there are also some parts of it: the passive investment approach, active management challenge, and portfolio diversification, practical investment accommodation. So you can understand market efficiency through that, and the behavior finance consideration is like you can integrate a behavior finance insight educate by investors. The psychology can lead to market efficiency awareness of psychology basis by bias empower the more strategic and investment making and businesses. The next step will be explained by the